Welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita Khemka. What a mayhem it has been, in the market today. We saw, the Nifty slide over 350 points. Sensex also, lost in excess of 1,000 points. But the pain is visible in the broader end of the markets. Look at the mid-cap index that has slumped or cracked nearly 4%, 2,100 point slide coming in on the mid cap index. The small cap index also down by a similar quantum, 4% or so. All the sectors deep in the red. If you look at the realty pack, that index lost in excess of almost 6% or so. The breadth was extremely poor. If you look at the NSE advance decline ratio, 1:10, 227 advances to 2,300 declines. That's the kind of poor breadth that we witnessed. You saw a spike in volatility index as well, up somewhere around 6% or thereabouts. All the sectors, deep in the red. The Nifty Bank index as well, 48,000. It's back at 48,000 levels. 1.5% cut coming in there. And if you look at some of the other sectors, look at autos, metals. All of these sectors are down by 2% or so. But as I mentioned, it was a realty pack that was down about 6% or so. Among the big losers, gainers were few and far between. But if you look at some of the notable losers on the index, Adani Group stocks, Adani Enterprises and Adani Ports among top losers. Trent, BPCL, Bharat Electronics, Power Grid, Tata Steel, NTPC, Grasim, Tata Motors. The list is long, and all these stocks have shed in excess of 3%. ONGC, Tech Mahindra, even the technology shares, that were gaining on Friday succumbed to, pressure, selling pressure, and you see some of these names like Tech Mahindra also among the laggards. But gainers were few and far between. So just four gainers on the Nifty. Axis Bank, TCS, IndusInd Bank and Hindustan Unilever. Aside of that, absolute mayhem in the market. We'll of course touch base with an expert and ask him what one needs to do and where one can look at hiding in such a scenario. But let's also take stock of some of the losers from the broader end of the market. Some result reactions, the likes of Just Dial, that stock tumbled in excess of 10%. You have Amber Enterprises, Adani Wilmar, PCBL, KFintech. These are some of the notable losers. But some stocks did manage to do well in a weak market. The likes of Piramal Pharma, AstraZeneca, Crisil, AB Capital. So these are some of the stocks that managed to hold their head above the water when it comes to the broader end of the markets. But the big talking point today was also the rupee. It was down by over 0.5% versus the dollar. In fact, hit a fresh record low, 86.59 if I'm not mistaken. That's the low that we saw on the rupee, sharpest fall since Feb 2023. So biggest fall coming in the last 2 years. Of course, we have Trump's inaugural ceremony just a week from now. He's going to take over a week from now, and markets are on tenterhooks, in the hopes of the kind of tariff announcements that he'll make. 60% was being talked about, but whatever he makes, 25, 30, whether the markets have discounted the worst, that's the question that's on everybody's mind. But there's been a big rally in the dollar index, almost touching 110. We were back at 101 or something late last year, but within the matter of 6 to 7 months, we are looking at 110 on the dollar index. A lot of these EM currencies have also slipped, but it was the rupee that felt the biggest impact. Of course, there are talks that there may not be any more rate cuts in the US this year. Bank of America has pointed that out, or other brokerages are saying there will be fewer, maybe one rate cut in the US. Could that delay the rate cut cycle back home as well? A lot of these questions are on top of investors' minds, especially with the kind of fall that we saw in the rupee. On that note, let me quickly bring on board then our guest for today. Joining me is Sandip Agarwal, who's a fund manager at Sowilo Investment Managers. Sandeep, not a very great afternoon. Look at the kind of fall that we've seen in the market. In technical parlance, one says that when the Nifty is moving towards what is called a death cross, and that could signal extreme bearishness in the market. How worse can it get, and how bearish are fund managers right now?
Yeah, hi, good afternoon, and thanks for having me on the show. So let me put it this way, that there is a fear that tiger will come, and that fear is putting the market where it is, because you have seen DXY rally and everything. So I think as soon as you already mentioned that once next week President Trump takes over, then I think this rally of DXI will also peter out. And if that happens, then probably you will see some relief everywhere. And also remember that the fear of unknown is always bigger than actual event. So while Trump is a very renowned negotiator and very hard negotiator, so I don't discount what he will do, but the style which he has, that scare the whole world and then you come to the negotiating table, and I think that's what he has been able to successfully do to the world markets, and we are no exception to that. So people are worried right now that what all action he will take once he comes, and in fear of that, you are seeing this kind of reaction, because fundamentally in long term we should always track what is the growth of the earnings of the country, and that should represent that should basically lead to our market levels. And I think we are now not in the very expensive zones, and even there has been a decent correction on mid and small cap, but although there is a lot of froth in some of the names still, but broadly, I would say that maybe once he comes and assumes office, after that you will see more of a relief situation rather than what we are seeing right now.
All right, so we could expect a relief rally, but you were talking about alluding to a lot of froth in the broader end of the markets. Do you think that froth has cleared out in the matter of a week or so? We've seen the mid-cap index shave off a significant, I think 8 to 9%, if I'm not mistaken. Last week it was down somewhere around 6%. Today is down 4%. So 10% correction in the mid-cap index as well in a matter of a week. So do you think there is some more clearing of froth that could happen, especially for the broader end of the markets?
So, unfortunately, market is not pure mathematics, so it always goes on extreme on both sides. So maybe it has become rational from mathematical point of view, but emotional and other parameters are also there, which decides the levels of the market. So I would say that we are probably entering the rational range, but how long market can go irrational on the other side also is very difficult to call out. But in my view, for long-term investors and for people who buy good quality companies through participating in any of the options which are available to the retail investor, I think they should be fine. Means this kind of ups and downs, some correction, are part and parcel of the larger wealth creation journey, and we should not panic in such situation. And if we have additional funds, people should ideally, participate in this kind of good price which are available in such scenarios.
So any thoughts as to where one could look for such bargains? If one has to take a bottoms up approach, would you recommend something in this market to hide? Where should one really hide?
So, let me put it this way, that, sector IT was like some place where people can hide, or pharma. But if you see in last few months, they have also run up a lot. So they are no more hiding space. But private banks looks really attractive now. And there are selective companies in each sector which have corrected 30-40% in last 2 months or 1.5 months. And those companies are not at all bad. It is just that they were being assigned a very insane multiple. And now with the prices correcting by 30-35%, some portion of rationality has come. So I would say that it is very difficult to call out one sector against another, because in every sector there are some good names and some expensive names. We should be very selective in what we are picking. Finally, a person should pay a certain peg ratio. That is the right way to invest. Or if you don't understand that, then basically, you should invest through experts, whichever form it is.
So, also talking about the big fall in rupee, do you think this would now delay the rate cut cycle back home as well? Because the US may not be in a hurry to cut rates again. If you look at some of the global brokerages, most of them have said that perhaps there could be no rate cut this year in the US. In that scenario, could a rate cut here in India be off the table?
Yeah, I would not say it is off the table, but there will be a lot more cautiousness before you do that, because if you see the food and vegetable inflation is also very sticky, and it has been quite up substantially, and it does hurt the middle class and the sections below that. So I don't think, in that kind of situation, it leaves a generous room for the RBI to go over and cut rates very fast. Although RBI is also cognizant that they need to give some booster to the economy. So I think rather than rate cut, maybe some more liquidity measures will be in place, which will probably fulfill both the purposes. That is the way we look at it.
Right. Talking about Just Dial in particular, I think it slumped somewhere around 13% or so. Although if you look at the margins, they aren't all that bad, right? Margins at 30% or so vis-a-vis at 22% last year. But some brokerages have pointed out that collections could be a pain point. But if you've looked at the numbers, what are your thoughts on this particular stock? And you think recovery in collections could take some more quarters? And in that sense, how would you look at the stock?
No, so it is, we run a PMS and we are SEBI registered PMS, so very hard to call anything on a particular stock. But let me tell you this way, that the situation right now today is that many stocks which have given good results, they have also gone down substantially. So it is a factor of fear, it is a factor of many other things. So very difficult to call out one particular name, but I would put it this way, that market is now moving towards risk averse for some time, and maybe post 20th of January, when market investors get some confidence and they start taking little risk on, then probably you will see similar kind of recovery on the other side as well. So I would say right now, any number which is not great, that will get punished very badly. Any number which is in line will get punished. Any number which is below will get very badly punished. So there are three things. One, no movement in case of great numbers. The other option, punishment in line with numbers, and even harsher punishment if numbers are below estimates. So we are going through that phase.
Sure, but if you talk about earnings visibility, where do you, or which sector do you see the maximum earnings visibility now? IT, we've spoken about it briefly. Commentary has been good, so that could be one. But aside of that, are you seeing any pockets where there is a fair bit of earnings visibility and one must use this correction to get into?
As you mentioned, IT, there is good visibility of earnings, but then the stocks are not so cheap as they were 6 months back. We also see good visibility in the manufacturing space across the board, because we as a country are now there are a lot of initiatives from the government, and there is also good demand because of multiple factors which are playing out globally, and we are seeing manufacturing sector across India in every segment doing phenomenally well, and it is just a matter of time when the numbers will also start coming in. So I think all these problems which we are seeing today in the market, they are probably going to fade away in next couple of months, because one, the earnings cycle earnings cut cycle will also start getting into the base effect from quarter 2. The inflation also, I think the food and fruit and vegetable inflation will also peter out slowly. DXY rally will also peter out, and after Trump comes, generally by the way he works, he will announce most of the things in first week of he assuming office. So all those things will settle down. So I see that this is a time pain and it is not a structural pain. That is the way I look at how things are shaping up.
Sure. After the Trump's takeover, the big event back home will be the budget. What would you be expecting from the finance minister this time? Anything by way of help from finance minister that you are betting on when it comes to the market?
I think the finance minister has done a very good job in last few years. We have been seeing consistently they have been focused on helping the middle class and the sections below that in a big way, and also enabling the industry through capex. So I think they have been presenting very balanced budget which caters to everyone. I think the budget this time will also be a mix of both taking care of the middle class and the lower section, and at the same time boosting the industry through capex. Because see, if you see numbers till now for this year, also the central government capex has been putting up well. Where we are a little bit lagging is on the state government side. So I think that will also pick up. So I am pretty confident that we are probably in the last leg of some pain left. but slowly this pain will pass because of combination of international and the domestic factors all coming towards positive end. That is the way we look at it.
We like the optimistic tone that you are striking, Sandeep. Last leg of the pain, let's all hope so. But, where are you in terms of looking at consumption now? Because, there could be some, consumption boosting measures in the budget as well. And last week onwards, we've seen some bit of interest coming back in the FMCG names, consumer staples, and and the likes. So after the kind of correction they've already seen, do you think it's a good time to look at those consumption names as well?
See, in consumption names, we have seen always in the budget, government ensures that more money goes into the middle and the lower section of the people so that, there is more disposable income in form of tax rebate, increase in standard deduction and minimum taxability and all those things. So this year will be no different. So that definitely is going to continue and that will help. But also remember at the same time that, consumption is also getting impacted because of new channels of distribution, new channels of selling also. That is also hurting the consumption businesses. And I think that is something which is little more, which will be here for some more time. And hence in the consumption side also, while it is a good hiding point today that they won't fall as much the market falls, but they won't recover also when market recovers to that extent. So I would rather say that, the approach has to be, and that is what we do in our PMS also. We focus on bottoms up earning growth led model rather than, sector allocation, because uh, it is very difficult for us to run some allocation system against each sector. We are more comfortable in finding bottom up ideas and then investing in them and then, having patience and see them play out. That is the way we prefer.
All right, point taken, Sandeep. But since we are talking, I would like to just get in your thoughts on one more, theme, so to say. A lot of subsectors have also come up, right, in recent times. Semiconductor, EMS stocks that have already turned out to be multi-bagger stocks. Of late, they may have been, witnessing selling pressure. But any such theme, new and emerging, that one could look at in terms of wealth creation?
No, the way we work for our PMS also, we go to the field and ground throughout the year. We are trying to look at basically what kind of capex is happening, and based on that capex, we try to buy those companies which are in some or other capex which large industries are doing. So top 20, 25 industrial houses do most of the capex in India, and whatever they are incurring capex on, excluding the imported machinery from the domestic side, whoever is contributing to those capex, we generally try to track them and invest in those names, because that is definitely going to create value. And it is easier also for us because, generally we have seen the sales to market cap is 3 to 4 times. So if capex is, let's say, $100,000, then you are going to create a market cap of $400,000 in simple terms. So we generally go by that pattern, that what the big industries are doing capex, and how we can break down that capex and who is providing for those capex, those ancillary industries. We try to find them out and we try to invest in that. It is a little tedious process, and we get lower success than the amount of effort we have to make. But once you get them right, you can hold on to them for 5-7 years, and it becomes much easier. So it is like, in the beginning it is very tough, then slowly your gain increases.
Sure, I mean, and that's the way to go by, right? Better be safe than be sorry. Of course, because when you incur losses, there is no limit to it. It's better to do your own research and spend some time and get a call right. I think that's the best approach. But with that, Sandeep, would like to thank you for taking out time and joining in this afternoon and putting things into perspective, and of course striking an optimistic note as well. We are the fag end of the pain, so let's hope that we could see some bit of a relief rally kicking in as we progress throughout the week. Thanks a lot for taking out time and joining in, Sandeep.
Thank you so much.
Well, with that, of course, leaving you guys with on a somber note, so to say, sub 23,000. One of my guests last week had said that he won't be surprised if we fall or if you look at Nifty, falling below that 23,000 mark as well. So let's hope that doesn't happen. We managed to defend that 23,000 level thus far, although it's a 350-point cut on the index. But let's hope, like Sandip was mentioning, that we are at the last leg of the pain that we are witnessing in the market, and we could see some bit of relief rally in the coming days. Perhaps the worst has already been factored in. But with that, completely timed out. Thanks a lot for taking out time and watching us this evening. But I'll be back with opening bell at 9 a.m. tomorrow morning, so don't forget to tune in. Thank you. Have a great evening.